This is Jody Trana with Chapter 3, Part 4, Principles of Accounting. It's always good to review our accounting rules, so let's start with the rules of adjusting entries. Remember that they're usually written at the very end of a period, so that would be the last day of that period, whether it's a month or a year. They will never affect cash, so your journal entry should not include a cash entry. And we will always be adjusting either a revenue account or an expense account. And also remember that our revenue accounts will always be credited because we are increasing revenue, and our expenses will always be debited because we are increasing expenses. One of the things I suggest is after you've written all of your adjusting journal entries in your general journal, that you just review all of your separate entries to make sure that these rules were followed. Make sure there are no adjustments to cash, and make sure that every single journal entry has either a debit to an expense account or a credit to a revenue account. Today we're going to be looking at adjusting entries that are a little bit more complicated. All of the information will be given to you, but you will have to determine what the amount is for your adjustment. We're going to do this looking at three questions. First of all, is it an expense adjustment or a revenue adjustment? This will help us know what our journal entry should look like. Second of all, what is the timing? We know that we are trying to adjust our revenue and expenses related to the end of a fiscal period. So how much time needs to be adjusted for? Is it a matter of days? Is it a month, or maybe even a full year of expenses? And then finally, what is the exact amount that we need to adjust for? Let's review this adjustment that needs to be made. Each Friday, LaRoche pays employees for the current week's work. The amount of the weekly payroll is $7,500 for a 5-day work week. This year, December 31 falls on a Wednesday. LaRoche will pay its employees on January 2. First of all, let's break this down by asking ourselves the three questions we talked about before. Is this an expense adjustment, or is this a revenue adjustment? We'll see that everything that we're talking about has to do with paying our employees. It has nothing to do with customers or revenue. So this adjustment is going to be an expense adjustment. Doing that, we know that our debit in our journal entry is going to be an expense account. And we also know that it's going to be salaries expense because that's what we're dealing with. Next, let's talk about the timing issue. We are told in this explanation that the payroll is paid on Friday for that week's work. That means on every Friday, we pay $7,500 to our employees that covers that week. This year, December 31 falls on a Wednesday. That means that Monday through Wednesday's paydays aren't going to be paid in December. They're going to be paid in January. If we paid this $7,500 in January and didn't make an adjusting journal entry, then our December salary expense would not reflect the correct amount for December, and our January would not reflect the correct amount for January. We need to accrue some salary expense to cover Monday, Tuesday, and Wednesday in December. Now let's talk about the amount. We already talked about the fact that $7,500 was the full payment for a 5-day work week. Let's calculate that as a daily amount. $7,500 per week is $1,500. $500 per day. So remember that we already talked about the fact that we need Monday, Tuesday, and Wednesday accrued into December's expenses. That's 3 days for our expense that we need. Let's step back and look at this entry from the beginning again. Each Friday, LaRoche pays employees for the current week's work. The amount of the weekly payroll is $7,500 for a 5-day work week. This year, December 31 falls on a Wednesday. LaRoche will pay its employees on January 2. What is the amount that we need to accrue for? What additional expenses do we need to add into December for this adjustment? We need a total adjustment of $4,500, which is the salary expense for the 3 days in December. And here's the journal entry. We already decided that we were going to debit salaries expense. Now we know it's for $4,500. And we need to credit salaries payable, which is a liability stating that we acknowledge our obligation to pay our salaries of $4,500. As we go through the rest of the adjustments that need to be made, we're going to use this process. Identifying first if it's an expense or revenue, determine the timing, and determine the amount. Then we'll write the journal entry. On January 1 of the current year, LaRoche purchases an insurance policy that covers 2 years for $2,500. Is this an expense or a revenue adjustment? It is an expense adjustment because paying for insurance is an expense. How about the timing? We know that it covers 2 years, and 1 year ago is when we purchased it. So the timing would be 1 year of insurance that needs to be expensed. The amount would be half of the full amount that was originally paid. So half of the amount is $1,250. And our journal entry on December 31 is insurance expense debited $1,250 and prepaid insurance credited $1,250. Notice our explanation is simple: to record insurance expense. The information for our third adjustment says the beginning balance of office supplies was $3,900. During the year, LaRoche purchased additional office supplies for $5,400, and at December 31, when we did our count, office supplies on hand that we actually have is $2,600. First of all, is this an expense or a revenue adjustment? It is an expense adjustment because we have used office supplies and we need to report those expenses for all of the office supplies that have been used. Timing here isn't as much of an issue as what the amount is. The timing is at December 31, what amount of office supplies have we used up? That's the big question. What did we use between the beginning balance and the ending balance on December 31? Let's take it one step at a time. First of all, we know that our beginning balance was $3,900. To our beginning balance, we need to add in all the office supplies that we purchased during the period. The next step is to deduct the office supplies that we still have on hand. Think about the purpose of what we're trying to accomplish here. We're trying to identify how many office supplies got used during the period. So we're trying to take the total amount that was available to use and subtract it out what we didn't use. That's what we have on hand. And the difference should be what we used. The amount of office supplies that we had on hand of $3,900 plus our purchases during the year of $5,400 minus the office supplies we still have on hand means that we've used $6,700, and that is the amount that needs to be expensed for our journal entry. We already decided that we would be debiting supplies expense. The amount is $6,700, and our credit is to office supplies to reduce our asset balance of office supplies down to what we actually have on hand of $2,600, and we do that by crediting the account for $6,700. During the month of December, Wksht designed a landscape plan, and the client prepaid $5,000. Wksht recorded this amount as unearned revenue. Remember that journal entry would have been cash debit of $5,000 and unearned revenue credit of $5,000. In that journal entry, we're acknowledging that we have an obligation to either return that $5,000 to the client or to perform the services. The job will take several months to complete, and Wksht estimates that the company has earned, at this point, the end of the year, 60% of the total revenue during this year. First of all, is this an expense or a revenue adjustment? It's clearly a revenue adjustment because that's what we're talking about: customers, payments, and revenue. Now we know that we're going to have a credit to our service revenue account. The timing tells us that 60% of the project was completed at this point in the year. If 60% of our obligation has been met and we have earned 60% of the unearned revenue, we want to transfer out the earned amount out of our unearned revenue account and into our service revenue account. That would be 60% of $5,000 or $3,000. The journal entry is a debit to unearned revenue for $3,000, which will reduce our unearned revenue for this client down to $2,000, and service revenue credit of $3,000. At December 31, Wksht had earned $4,500 for landscape services completed for turnkey appliances. Turnkey has stated that it will pay Wksht on January 10. Is this an expense or a revenue adjusting journal entry? Again, we're talking about customers and we're talking about money that we've earned, so we are talking about revenue. That means our journal entry is going to have a credit to service revenue in it. That can help us think about what the debit should be. Turnkey has stated that they will be paying Wksht on January 10. That means that we can expect to receive money from them. That puts the debit in accounts receivable. And our journal entry is accounts receivable debit of $4,500 and service revenue credit of $4,500. Notice the simple explanation: to accrue service revenue. Depreciation for the current year includes our equipment for $3,300 and our trucks for $2,100. Is this an expense or a revenue adjustment? Depreciation is an expense, so these are both expense adjustments. And remember that our coordinating accounts for depreciation expense is our accumulated depreciation, which is a contra asset account. Let's review that briefly. This is a section off of a balance sheet for Smart Touch Learning. You can see here that the furniture account is $18,000. That is our original purchase price of the furniture. That amount, the furniture account itself, will never go down until we sell that furniture and totally dispose of it. The way that we show depreciation on the furniture is with our contra asset account of accumulated depreciation furniture. This number, which shows a $3,000 credit right now, that number will grow to a full $18,000 over time, in which we will show net furniture balance of 0. Same thing with our building account. It's showing at a $60,000 balance right now. That will never change until we either add to the building or dispose of the building. This journal entry is written as a compound journal entry to adjust depreciation for both our equipment and our trucks. You could write this for 2 separate journal entries if you choose. Remember that our coordinating accounts are depreciation expense and accumulated depreciation. Accumulated depreciation is going to show a reduction to our equipment account on the balance sheet, where our actual equipment account will not be reduced in value. LaRoche has incurred $400 of interest expense on a $900 interest payment that is due on January 15. Is this an expense or a revenue adjustment? It tells us right in the explanation that it is an interest expense adjustment. So we will have a debit to interest expense and a credit to interest payable. The timing. The actual interest payment is not due until January 15. If we made that payment on January 15 without an accrual adjustment, then our December interest is not going to reflect the correct amount for December, and our January expenses are not going to reflect the correct amount for January expenses. We need to determine the amount, which they've told us, of $500 that needs to be expensed in December, even though it will be paid in January. Our journal entry is interest expense debit and interest payable credit. Let's talk about where an adjusted trial balance comes from and its significance. An unadjusted trial balance is what we start with. It is usually our trial balance that is at the end of a period but does not have any adjustments considered for it. We're just taking our most current list of all of our accounts from our ledger, and we are putting them in a report to make sure that all of our ledger accounts balance. That's the purpose of our unadjusted trial balance. Then we make adjusting journal entries. Those are usually journal entries that happen at the end of a period that are made in order to get our revenue accounts correct and our expense accounts correct. We need to post those journal entries to our ledger accounts, and once we do, we have new balances that we need to put into an adjusted trial balance. At the end of every fiscal period, an adjusted trial balance is prepared. It is considered more accurate than the unadjusted because it includes the adjustments. It will be a summary of all accounts with their adjustments. The purpose of doing a trial balance is to make sure that your debits and your credits equal. Once you are assured that your debits and credits equal, you can create your income statement out of your revenue and expense accounts and your balance sheet out of your assets, liabilities, and equity accounts. The worksheet can also be used to create these statements. Here you can see how we have transferred the accounts over into the income statement columns from our adjusted trial balance. Since our revenue exceeds our expenses, we have a net income of $8,550. We can also transfer our balance sheet amounts over from our adjusted trial balance numbers. Our debit and our credit column are off by the exact same amount of our net income. This amount will be put into a current year earning account in our capital account to ensure that our balance sheet balances. Let's talk about how to use the trial balance worksheet. The first step is to fill out all of your balances from your unadjusted general ledger accounts. Every account balance should be entered into these debit and credit columns, and you should ensure that your debits equal your credits. The second step is to enter all of your adjustments from your general journal, where you've written your journal entries, into the trial balance worksheet. You'll see that each one of these adjustments is labeled as A, B, C, D. That way they can be tracked if there's any question. These have come from our journal entries, so they should balance, but we also determine by adding up the debit and the credit column that they do indeed balance. The next step is to fill in your adjusted trial balance numbers. These numbers can come from two places. First of all, your general ledger accounts should have these amounts in them. You can just transfer those amounts over to your adjusted trial balance here. It's a good idea, however, to do a little bit of math on this worksheet in order to just test your general ledger account balances to make sure they're correct. You should be able to take your unadjusted trial balance numbers on this worksheet, add or subtract your adjustments, and come up with your new balance. Let's take accounts receivable as our first example. Our accounts receivable unadjusted trial balance was a debit of $1,000. We made an adjustment to it of $800 debit. A debit plus a debit equals a larger debit, and you can see that our adjusted trial balance equals the combination of these two numbers at $1,800. Now let's look at office supplies. Office supplies is right below accounts receivable. Our unadjusted trial balance was $500 debit. To that amount, we credited an adjustment of $400. That would reduce our office supply debit down to a $100 debit, which you can see in our adjusted trial balance debit column. Once you add up each one of these columns in your adjusted trial balance, they should balance to show that all of your accounts in your general ledger are in balance. The next step in completing a trial balance worksheet would be to create an income statement and balance sheet using the numbers that are on your worksheet. Here we have a completed trial balance worksheet. Notice that all the account columns balance until we get to the income statement. The income statement doesn't balance because our revenue is greater than our expenses. This is a good thing. It shows our net income. Our balance sheet also doesn't balance because of this same feature, our net income. When we do our balance sheet report, we will take the $8,550 that's net income, and we'll put that into our equity area as a current year earnings account, and then our balance sheet will balance. Don't forget that there is help with these deferral and accrual journal entries if you need it. This reference is in Canvas. It's also in your Pearson materials. This is Exhibit 3-3, so you can search your e-text for this or the book.